Hey everybody, JJ here. Welcome back for another Saturday of Zoom Networking. Today's guest speaker is none other than my good friend, Eric Martel. Fantastic guy, great knowledge. He's the patriarch of the Martel family, the Martel real estate empire. Eric, welcome to the show today. How you doing, brother?
Well, thank you for having me, JJ.
Hey, Eric, it's a pleasure to have you here, brother. Good to see you again. I've been following a little bit about what you and your family's been doing. You guys are really knocking it out of the park. Really briefly, I'm just going to hand it to you, but I'll let you talk about your new book, as I understand.
Mm-hmm.
And for those that don't know about you and the family, you can talk a little bit about the great things you guys have been doing and have done. And take it away.
All right. Well, thank you, JJ. Thank you for having me. Again, a very nice group. I really appreciate the introduction at the beginning with everybody. So I can see that there's a lot of people that have significant experience in real estate. So that this is very good news. But I still want to share kind of my journey and kind of what we're doing. I'm actually in Las Vegas right now. And then I have a problem with this light, so it might flicker. I don't know. It flickered earlier today for another video. But we are at the Real Estate Domination Conference in Las Vegas. My son Antoine and I, Ty Lopez was, I don't know if you guys know, but he was talking yesterday. We had Dr. Alex Mayer also spoke yesterday, and a bunch of other great speakers. So it was fantastic for us. For a Martel family to actually, Antoine was presenting to really speak in front of these real estate investors. So that was good. And again, happy to be here. Today, it's really, it's not me about presenting really the one-sided conversation. I want to get to the Q&A, which is the last item there. But I want to share my journey, kind of maybe a little bit different perspective. I think I spoke, a year ago or 2 years ago for your group, JJ. Now I have the book out, so I really want to focus on that. Part of the book is about the mindset, but so many people are talking about mindset that I'm not going to spend too much time on that. I'm just going to talk about one tool that I have in my book, that one exercise that you can go through and that you can think about. But I think the one of the key element is strategy alignment, which is something that is very important. And then when I'm looking at and speaking with investors out there, I can see that they keep changing focus and they keep looking for the next shiny object. And I think that strategy alignment tool is going to make sure that they pick a strategy that makes sense for them, where they're going to be most likely successful. And then after that, we can jump into the Q&A if you have any kind of questions related to real estate and whatnot. So I bought my first apartment building in my second year of university. I had met a great person, a regular kind of like community college teacher that was a real estate investor. And that became kind of like my rich dad, poor dad moment. I graduated in actuarial mathematics and started working as a consulting actuary. And basically my day-to-day job was to destroy corporate pension plan and convert them all into defined contribution plan, or 401ks. So that really shifted the risk of retirement from the employer, who was guaranteeing a final income at retirement, and shifted that risk to the employees, who now had to invest, had to save, and had to figure out how to convert that 401k money into a stream of income. And this is one of the main reason why I wrote the book, is that the importance of achieving financial freedom is even more important now than it ever was, because so many people have not saved enough money to retire. And so that's why everybody should be, their number one goal should be to achieve financial freedom as soon as possible. So that, as you can imagine, this was a little bit depressing working in that kind of environment. And actuaries are not fun in general. So I moved to the high-tech sector, a much more fun group. joined a big company, and then they had stock options at the time. I had tons of stock options, and then basically lost a fortune during the dot-com crash. And this is kind of where my focus moved to passive income and legacy, building a legacy for my children. A few years later, we launched Martel Turnkey, and we currently do about 120 rental flips a year. We currently have about 100, like 95 to 100 projects, real estate projects in progress right now at different stages of development. And of course, we spend a lot of time educating people and answering questions to potential investors and people that have like regular W-2 job and they want to start working and build a passive income portfolio so they can achieve financial freedom. So that's a little bit about me. And really my background is very kind of like very ordinary, I would say. My parents were just like middle class, lower middle class, working 9 to 5, paycheck to paycheck, not very ordinary kind of things. But my parents, like all the workers, they were not in control of their life. Their life was controlled by the punch clock, having to punch for time whenever they went to work and whenever they left work. And then they were paid like for every minute that they worked there. And then bills, that was their world, punching the time for time. And then, the bills, paying the bills every day, making sure that you didn't miss one. But I knew there was a gap because I had met other people through some of the things that I was doing and through school and all of that. I knew there were some things that they were missing. There were a gap between what their view of the world was and, but I mean, the banking industry, or banking system, the money and business. I mean, they didn't understand kind of how some guy that started the business went bankrupt in his business, but he still had his house and he was still driving his fancy car and, things like that. They didn't understand many of these things. And they thought that basically being rich was because you were a cheater and that you were somehow, doing something illegal that you were not caught, something like that. Instead of, and what I viewed was that there was really a gap in their understanding. They didn't understand how these people structured their deal to minimize their risk and be able to invest. And if my parents didn't know how the system worked, so they couldn't tell me or teach me what the system was. And you certainly couldn't count on the education system to tell you how the system worked either. So I was kind of stuck. And I got unstuck really when I arrived at university, and I was introduced to that real estate investor. And that real estate investor, I know he's not on the call today, so he won't be insulted if I'm to say that he was no genius. He was just a regular guy, a community college teacher, and he was a good guy, but his strength was his discipline. He was very disciplined about his approach, and he was very focused on what he was doing. It was very, it was very important for him. He was always going one step closer to his goal every day, every single day. He would wake up early in the morning, have his coffee and pad of paper, and he would work in a very disciplined fashion to go towards his goal, whatever he was doing. He managed to build and own a 36-unit apartment building. He had bought a big piece of land, and he was building a shopping mall last time I talked to him. And he had built some nursing homes as well. So, and again, just a regular college teacher. And this was really my rich dad, poor dad kind of moment. And I realized that level of, the gap in understanding of how the system worked and all of that. So I knew at that moment that I need to learn from him. I knew I wouldn't learn that from the education system. I wouldn't learn that from my parents, but this guy had done it. I want to talk to him. I want to learn as much as I can. And so he agreed to basically be my mentor during that time and be my coach. And I said, okay, well, I have no money. And I said, no problem. And he said, but I have lots of time to kind of like look at things and see what we can do. And so he taught me how to find a deal, what the deal looked like, and how to run some numbers. And so, got a realtor, and then he would send me some, I would send him my criteria, my investment criteria, and he would send me a couple. First, initially he said, well, that doesn't exist, you can't find that. And then every week he would bring me some new listings and say, try these listings. And then the numbers didn't work. And then I said, no, not that, not that, not that. And then we went back and forth. And he got kind of tired of me. And then he basically, in those days, there was no internet. And so he basically gave me a pile of listings, MLS listing that was printed, and said, here you go. You just go at it. And then you tell me if you find something. And I think he was hoping that this would shut me up for a while. So I spent the whole weekend working at it, and I found 3 deals that could potentially work. And one of them ended up being someone that was willing, the seller was willing to do seller financing in the second position. So that's the deal we went forward with. And I ended up, getting financing from a credit union. Second lien was from the seller. And then was able to close that way, and it was still cash flowing, no money down, cash flowing from day one. All it was tenanted, and so I said, okay, well, this is very good deal. And then, but it was a lot of work, right? So it was, and at that time I was very young, so I didn't think, oh, this is. It was not part of a grand plan or a grand goal of achieving financial freedom. It was really to prove to myself that it was possible for me to do this kind of transaction that was cash making money without me having to work. So that was the great, kind of like the great test, I would say, of this. And this is what's important in this. And this is one of the tools that I have also in my book is the belief inventory. So there's a lot of people have a lot of different belief or misconception about how the system works, or we keep repeating these mantras about that a home is an investment, and then that renting is throwing money away, or that kind of stuff, or that all kinds of mantras and things like that, beliefs that are incorrect, or at the very least incomplete. And so I think it's important that you kind of list that. And this is one of the exercise that in my book is to talk about that, to building a belief inventory, and then kind of like really getting a little deeper on these beliefs that are limiting us to achieve that. There are a lot of talks about mindset and belief, limiting beliefs and stuff like that. So I'm not going to spend a lot of time on that. So. But that's something to for you to think about and do this. But the goal was really after that to look for my next deal, right? And the saying at the time was to look for deals in your backyard, because you can walk by it, you can do all of that. And I graduated. After graduation, I moved to Toronto. Tried to find deals there. Then I bought a house, did some house hacking there. Didn't particularly enjoy having tenants in my basement, and then I moved to San Francisco Bay Area, and this is when I had joined that startup, and I had tons of stock options. Even I had like tons of money. I was trying to look for opportunities in San Francisco and in the San Francisco Bay Area, and the numbers didn't really make a lot of sense. I mean, in order for something to cash flow and give me like a decent return, it would be way too much cash, and the cash on cash return would be like 1% to 2%. So it really didn't make sense. I mean, then I said, well, I might as well just leave it in the stock market. It's liquid. I don't have as many issues there, and the rate of return is much higher. Up until the dot-com bubble burst, early 2001, and this is when basically wiped me out, wiped out all the stock options. And then caused me to rethink kind of my priorities. And it was really about being more in control of my investment, of my business. And of course, you can't always be, that's why I have control in quotes here, is that you can't always be in complete control. You don't control the economy and what's going on there. but I felt that at least I would be more on the pulse of what was going on in the economy, because I would be interacting, I would be doing transaction with customers, with suppliers, or whatever I was doing. So I think it was pretty important. Then that way I would know what's going on and I would be able to react to the environment. And I talk about that a little bit later when I talk about our business today and how we shift how we do business to kind of shift the risk away from us and then maybe closer to us to increase our returns. But and we can talk about that a little bit later. The other thing too is about get my time back. And again, stop trading your time for money. Getting my time back was very, very important. Only you can take care of your money. And I felt that if I had more time to dedicate to managing my asset, I would be able to, I would have done a better job, and maybe I wouldn't have lost, so much money. And then, so I wanted to, in order to get more time, I wanted to focus more on passive income, but also passive income where I would be able to travel and work anywhere. So when we talk about deals in my backyard, that kind of like, well, I had to kind of be close to me, but I couldn't find opportunities close to me. So it was a bit of a problem. But luckily, around these days, 2003 to 2007, we got a number of technology that came into play that really expanded and made the world a little bit closer, or easier to make transaction pretty much anywhere you wanted in the world. And this is kind of like when my thinking shifted to I can live anywhere I want or travel, but I have to invest where it makes sense, right? So that now the shift was, this is a strategy that I want to do. Where do I find deals that fit my buy box, that fit my goal? So that was the key element. So yeah, tons of deals now. All of a sudden I have deals not only in my backyard, but I have deals on the East Coast, in the Midwest, deals everywhere. And how do I find out what is the best deal for me? Right, so I had to focus, find an area of focus, and not going from shiny object to shiny object. So I find a goal, and my goal was to achieve financial freedom, generate a passive income portfolio. And so I had to make sure that, and again, even for passive income, there are different strategies for achieving that, for doing passive income strategy. And this is kind of where this alignment came into play, because I have all these deals, I have all these types of strategies that fit. I can come up and take out a bunch of those deals, and that don't generate passive income. So I'm not going to do like multiple flips. I'm not going to do maybe some wholesaling, because it's not, I have to work a lot at it to make it work. So I can reduce the number of deals that I see here to focus on the passive income strategy. But even then, there are a lot of strategies that generate passive income. And so how do we figure out this? So that's kind of where I came up with a strategy alignment triangle, where you kind of have your goal as a top, which is the financial freedom. You have a number of strategies, and you're going to pick one. But what makes the strategy work is the resources that you have, right? And the resources are going to be your time, your money, and your capabilities. So the skills that you have, or the skills that you can bring to the table, right? So when we look at so time is pretty obvious. If you work full time, you probably don't have too much time to dedicate to a strategy that's going to require you to manage workers, manage contractors, and all of that, and spend like 40 hours a week dealing with that, right? So you want something that's a little bit more hands off. In terms of money, I mean, if you do these large projects, you're going to have access to significant amount of cash, even though you might be able to get a mortgage or a loan to fit that. So how do you do that? If you have to travel to these locations, you also have to do that and be able to take time off from work to do that. So there's these two, at least the time and the money are the two biggest one probably for most people. And then there's like capabilities. So if you're a doctor, if you're part of the medical profession, maybe investing in a medical building would make sense, right? But if you don't know anything about that, you're not part of the medical community, it might be hard for you to understand what is needed for a medical building to work. What are the requirements, and who are you gonna, lease these offices or this space to? So that's where the capabilities come from. Or maybe if you're a contractor, or if you have some special skills. I spoke to a lady a while back, and she was specialized in land, all kinds of land, and she had access to satellite pictures. And then she was analyzing path of progress in lands in in all kinds of areas of the United States. Well, I don't have access to that, so for me, I'm not going to invest in the kind of deals that she's working on. So that's kind of like the idea here. So you kind of start working with your resources, and then that kind of gives you an idea of kind of like the time, and we look at the money or the risk that you want to take for that. And so I looked at all the different strategies, and then I put them in quadrants, right? So and basically on the time axis is kind of how long would it take you to basically get this strategy off the ground. And on the risk side is kind of like what if you look at the variance of potential returns that you would have. So this is kind of like the range that would be the bigger the variance, then that means the bigger the risk. The less the variance, then the less the risk. This is obviously a very unscientific approach because I don't have data to really look at that. But basically, based on my experience and after speaking with some individual, I kind of gauge where the risks lie for each of the different passive income strategies. So these are all passive income strategies that I looked at. So you're not going to see like residential flip, for example, in here, because in my opinion, it's not really a passive income strategy here. So obviously at the very bottom and left corner, this is where you want to be. This is the thing that's easiest to get off the ground. And this is also the thing that has maybe the least amount of risk, because it's turnkey. You already know the tenant, you know the price, you don't have to do renovations, you know the market, you have the property management in place, and you can see also you can do turnkey apartment. It takes a little bit more time, a little bit more risky because you put more money down. Private money lending, so a little bit more risk, a little bit more time based on turnkey single family rentals. Right, so that's kind of where we shifted and said, okay, well, let's do, and this is how we got started. We say, let's do the turnkey single family rental. And then when we did that, it kind of worked, but there's a lot of things that we didn't like about that. When we started, we wanted to just build a passive income portfolio. That's all we wanted to do. And then people became aware of what we were doing, and they say, well, I want to invest with you. I want to buy one of those rental properties from you. And after we talked to a lot of these turnkey providers, there was a number of things that we didn't like when we talked to them. And so when we decided to launch Martel Turnkey, we said, well, we want to do it right. We don't want to do the same kind of, not necessarily mistakes, but we don't want to take the same approach that other turnkey providers have taken. And one of them was, a lot of turnkey providers out there, when you buy the property, it's vacant. So you're as an investor, you're at risk for finding the tenant. You don't know how long it's going to take to find the tenant. And you don't even know if the rent is going to be the same rent that the seller told you about, the turnkey provider. And to us, it didn't make a lot of sense, because the turnkey provider is the expert in the market, and he should be able to tell you that, hey, yeah, this is going to rent at $950. But often they could inflate what that rent is, and then you end up that it can only rent at $850, and then you're the one that is at fault here, that is paying for it. So we wanted to sell our properties with a tenant in place at the rent that we said it would rent, cash day one cash flow. That means like as soon as you buy the property, you're good to go. Somebody is paying the rent for you from day one. Also, next thing is that we never overpay. So that a lot of the turnkey providers out there, they sell you the property at $100,000, but then you get a mortgage, the bank gets the appraisal and they say, well, it's only the price is only $90,000. Well, guess what, Mr. Investor or Mrs. Investor, you have to come up with the difference in cash, because now the bank is not going to be providing the full mortgage. So, but that affects your return. So obviously you're going to have more cash in the deal, and now maybe it's going to take 2 months to find a tenant at a reduced rent. And now what you thought was a 15% return is now a 8% return, cash on cash return. And then the other one is about third-party property management, where we thought there was a little bit of a conflict of interest, and where the turnkey provider could kind of like reduce the level of renovations that they do, because they could always charge you later on in the back end at a premium. So we didn't feel that was right about that. So when we work with third-party property management company, for us, the third-party property management, that's a mouthful. That property management company actually does a quality check for them before the house gets onto their platform. So this is another, not only do you have the appraisal going through, you have the property inspection going through, but now you have the third-party property management company also sending their quality control person to visit the property to make sure that it's rented. And some of our markets, we even have like the city inspection. So we do a rental inspection on top of all that. So from an investor that want to buy a turnkey rental property, we think that this is a pretty good deal. You get cash flow from day one, you get at appraised value, you don't have to come up with additional cash, and then you have a third-party property management company to make sure that all the renovations are done properly, and you have the property inspection and all of that. So this is what we started, why we started, or how we started Martel Turnkey, with that these three kind of like differentiators, I would say, compared to other turnkey providers. And then we looked right now at these markets. So Memphis, Tennessee, Cleveland, Ohio, St. Louis, and Detroit. We just started Detroit this year. And so we're just on the outskirt of Detroit, a couple of different neighborhoods there that are up and coming. So it's not like you're not in a bad area, very nice area. And then when you look at our website, you can see the map for yourself and talk to one of our salesperson to kind of show you what's out there. But yeah, so Memphis, that's where we started. This is the first house that we bought for our portfolio. And then Cleveland was shortly after that. Then we did St. Louis, and now we're adding Detroit this year. Typical houses that we have, if you go on our website, martelturnkey.com, this is what we have. Again, this is not, I don't want to mean to talk about, I'm not selling Martel Turnkey, but I just want to show you some of the turnkey rental properties that we have. And then, so the kind of returns that you get. So you would get this turnkey rental property. Again, the easy to do if you have a W-2 income, minimal risk, and then you have these kinds of return, 10%, 12%, cash on cash return. And these are the initial investments that you would do for that, right? This is after you pay for property management company, the property management, after you pay for the mortgage as well. So the $281 in net cash flow for this particular property in Cleveland, and then, after you pay the mortgage and everything. So that's the turnkey. I mean, you could go and do kind of like the BRRRR method. So everybody should probably know about the BRRRR method, but then you can go in that direction. This is probably kind of like the next level, I would say, that is kind of similar in types of investment. But instead of buying it from a turnkey rental company, you're just going to do it from scratch. So you're going to buy the distressed property, you're going to renovate it, rent it, refinance it, and then you're going to repeat it. And this strategy is a little bit more time consuming, as you can imagine, because you have to figure out which market you're going to go in, do all your analysis. You can replicate obviously what other investors are doing. So you may decide, oh, I'm going to go to Memphis, so I'm going to go in Cleveland. But then you still have to find a property management company. You still have to find the right contractor. You still have to find the right neighborhood and working with the right realtor to bring you the right opportunity. So that's what you would do. And then you would dive into that particular market with the realtor, the contractor, and the property management, making sure that they're the right people for your team. And then any kind of things that happen with the permitting, city inspections, rental inspection, some of the sites, for example, in Cleveland, we have to deal with the point of sale as well, that inspection that need to happen, and we have to leave money in escrow to finish the renovations, identifying the right neighborhood, and then vetting the market rent. So a lot of work that needs to happen, and this is why it's very different than a turnkey kind of turnkey investment. You have to figure all that out, make sure that everything makes sense, and then and then you make your investment. Again, minimize your risk, buy something a little bit small, so this is what the number would look like for something that's that you would get on the market today, right? So in Cleveland or in Memphis, you could get a property right now for about $50,000, distressed property. You would rehab them for about 30 to 35, around $30,000, and then you would have to pay taxes, insurance, closing costs, $3,000. So you'd be all in for $88,000, right? And the after repair value for that property would be $100,000, right? So that's a pretty good deal. You added some value, and then you would have that, and then you would go to a bank, and then you get 75% loan to value. You get $75,000 back, and then you paid $88,000. So that means you have about $13,000 left in the deal. That's pretty good. You have a house for $13,000, and then you can go and do another property after that. A lot of people are talking about, oh yeah, but I got all my money out. I mean, I think it did happen. There was, and it's probably still can happen now, but I think, as you know, the market is a little bit different these days. So I think the deals where you were able to get all your money out, they're far and few between. And then this is a very likely scenario of what you would get and what we would see in the markets today. In terms of cash flow, so the rental income for that property are about $1,000. So if you're familiar with that, that 1% rule, that fits right into the 1% rule. So $1,000 divided by $100,000 in the value for the property. And then your taxes, your property management, and you end up with $700 in net operating income. And then your debt service now is $380, and you have a net cash flow of $420. So that's pretty good cash flow, about 40% cash on cash return. So that's excellent. Obviously better than a turnkey rental. In order to do this deal, you have to spend a lot more time. It's a lot more time consuming. There's more risk. In order to get to that 75% loan to value ratio, you have to wait for a seasoning period, depending on your lender. It could be about 6 months, sometimes a year, before you can get your full value for that. So that means you're out $88,000 for a full year before you actually, are able to get that 75% loan to value. So very possible, better return, obviously, but also a little bit more work to get to that. And so there we go. And in terms of scaling, so there's different direction, obviously, that you can use for scaling this business. So this business model, either business model, the turnkey, or this one, the BRRRR method. So how do I scale that? Well, if I want to go something like and do a lot of those things, I mean, I'm going to need a lot of money, right? For each of these deals, I need, let's say, $88,000. So I need to find more money. So this is where the private money lending would come into play. This is also where you could do a lot of joint venture. And as you build your track record with other investors, and you build your network, you would be able to attract investors to put money, like JJ, for example, put this $300,000 at 12% into some deals, right? So you could find these people that have extra cash floating around, and they would invest in you, give you $88,000 to do one of these properties and refinance them, and then you pay them back. Joint ventures, similarly, if you want to do that, they can wait, and then you can figure out a way to pay them out at the end. All these, yeah. So if you want to go big and then kind of resell and do turnkey rentals like what we're doing, then scaling that is even more challenging, because you have to figure out the personnel, the partners, more partners that you need, more contractors that you need to bring to the table, and then shifting the risks, right? So the risk is very important, because there's a couple of things when you're selling. If you're deciding to do BRRRR, but instead of refinancing at the end, you decide, like we do, to resell it to another investor, there's a significant amount of risk of how long it's going to take to do that, how much it's going to cost, how much profit you're going to make, is the ARV the right value that you were able to sell the property at. So all these risk factor, I mean, it depends how comfortable you are with them. Obviously, if you're using a private money lender and the duration of the project is longer, that means that you're going to share more of the cost of that, you're going to have more costs for that particular project. So that's going to reduce your profit. If you do joint venture, you don't have to pay the interest every month. You just share the profit at the end. So that way, the risk is really shared between you and the joint venture, the other investor that's in with you. And this is kind of what happened with us, like over time as well. Like we've shifted a lot between the private money lending and joint venture. When the pandemic hit last year, we were heavy on private money lending. We had tons of basically everything was private money lending. And then what happened is that now we thought, okay, what's going to happen? Like if the pandemic, all of a sudden we can't sell a house for, like, it takes a year and a half, right? At that time, it was taking us like 3 to 4 months to sell a house. How do we share the risk? How do we protect ourselves if all of a sudden we can't sell the property, or it takes a year to sell the property instead of 3 months? That's when we shifted everybody to a joint venture. And then, so that way we didn't have to pay interest every month. It cost us more money because we had to share the profit now for these with the investor, but at least we shifted the risk to, we shared the risk basically with the investor. So if it was delayed, we didn't have to pay interest, and the profit may have been a little bit less. And then that way it was really protecting our business. And this is when I talked earlier about being more on the pulse of what was going on and being able to react to the environment. This is what I meant, is that now that we have the business, we are able to control. We have many levers that we can use to control and shift the risk away from us, and then lose a little bit of return. Yes, we'll pay for that, or bring the risk back onto us and then make more returns. So make a higher return. So that's what I mean. So we can play with these levers, and we can adjust and say, oh, we're going to do 50% PML, 50% JVs, or we can, depending on where we are. And the idea here is that basically we want to plan for a lot of different eventualities. A lot of people are trying to predict the future, and the trick is to know what all the futures are, and then determine, kind of like prepare and plan for all the different futures. There are some futures that are more likely than others, so you would kind of like prepare more for that than the other futures. And but yeah, so this is the idea. A lot of people are trying to predict the future, and then they get it wrong, then they lose. But the idea is that you have to predict for all the different outcomes, and the most likely outcomes. This is what you spend the most time with. The other trick that is very important in this business is cash flow. I mean, you've probably figured out if you have 2 or 3 projects going on right now in real estate, you're going to realize that cash flow is very important. So when you're running 100 projects together and in parallel, you're going to see that cash flow is extremely important. And we actually had to develop some pretty unique tools in-house to basically monitor and predict our cash flow 2 months in advance, 2-3 months in advance, so that we know that, hey, we're going to go and hit a low spot. We're going to be, and then we make sure that we always have enough reserve to get through anything that we're doing. So that's especially important when sales are moved away, like they're delayed, and then where acquisitions are kind of like changed a little bit. So that's why we're doing it that way. All right. So I think I'm ready for the questions. If you have any questions, the QR code here is to give you access to my book. It's on Amazon. And basically, I talk about that. There's like 3 sections. One of them is the mindset, where we talk about the belief inventory exercise. We talk about the strategy alignments. There's a couple of chapters on that. Then all kinds of different tools and formulas on measuring performance, and really walking you through the process from end to end, from finding the market, building the team in that market, acquisition, and then closing the deal. So I'm hoping that by the end of the book, you would have completed at least 1 transaction, and then some. JJ, back to you.
Hey, great. Eric, that's fantastic. Thank you so much for sharing all your wealth of knowledge. I've been, honored to have you to the house for some of my networking events and meet the boys and yourself. And I'm just amazed at what you guys have done and put together, all the states you guys are working in, and all the level of success you guys have achieved. So I want to thank you on behalf of the group for coming in to speak today. And for everybody else, stick around. We're going to have the Q&A following this. Don't forget to subscribe to Flipside Up with JJ so that you can follow Eric and the other speakers we have on our YouTube channel. And everybody else, next Saturday, we have Stephen and Caroline Allen coming to speak with us. So look for that video soon. And everyone else, we'll see you soon. Over and out.